Here are 5 questions to ask before buying a stock. Every time you want to make an investment, please ask these 5 questions, and based on the answers you get, you will determine if this is a good business or not. If you buy the business, if you buy the stock or not. Please leave a like, that's very important for the YouTube channel, and now we can start. The first question to ask is, do you understand the business? Stocks are not lottery tickets. Stocks are partial ownership of a business. So when you buy a stock, you buy a real business. Do I really understand it? That's a very stupid question, put it this way, but I have to really understand how a business makes money. What are the different segments inside a company? And are they profitable, not profitable? What are the different margins for each segment? And for each business segment, is it growing or not? Is it profitable or not? I want to know these kind of things before I invest in a stock. And based on all this information, all this research, the goal is to sum up the business thesis, the investment plan in 2 minutes to a 10-year-old child. You have to be able to pitch the investment case to a child under 2 minutes. And this exercise will disqualify 99% of investment opportunities because a lot of businesses are very complex with many different segments. If you talk about a technological company with nano chips and 7 nanometers chips that will disrupt the industry because of heavy regulation coming from China and because of Taiwan coming chips, you've lost the child. That's already too difficult for him. That means that it may be too difficult for you. The investment thesis is just too hard, too complex. So that's the first question. Do I really understand the business? And can I sum it up in 2 minutes with simple words to a 10-year-old child? The second question to ask before you buy a stock is this a good business? So I suppose you have checked the past growth of the business, the profitability. Well, you want to invest in strong growth, profitable businesses that will deliver great returns in the future. So that's purely quantitative. Check the margins. It could be gross margins, operating margins, free cash flow margins. You can check the past growth, so revenue compounded annual growth rate, CAGR, net income CAGR, free cash flow CAGR. Does the business generate a lot of cash? Is the business asset light or asset heavy? This has an influence because asset light businesses like a software company, well, this kind of business can be much more profitable because at the end of the year, they don't have to reinvest in new warehouses, new machineries. This is a software company, so they can enjoy high margins for years and years. In the opposite situation, you have asset-heavy businesses that need this kind of reinvestment. The capital expenditures at the end of the year, they will use the cash they've generated to reinvest in this new machinery. They employ a lot of people, so you have to pay these new employees. That's 2 different kind of business models. So maybe you will have a preference, but this is the kind of question that I love to ask myself because you can be blinded sometimes by a CEO or a business model that you find terrific. But at the end of the day, is this business profitable? Does this business have a lot of growth ahead? Is this business tech heavy or does it have to invest in a lot of new machinery and is slow? That's the kind of quantitative metrics that you can check when you want to invest in a business. The third question to ask is, does this business have a competitive advantage? Is it special, different from competition? How is my investment, my potential investment, better than other investments in the industry? How is it special? How is it better? I want to know. Do they have better margins, better products, better services? I'm thinking about Alphabet, Google right now, or Meta platforms, or Coca-Cola. These 3 companies, they have a moat. They are superior to competition. Or you can think about Ferrari that has a moat because of its brand, its luxury products, so they can have a pricing power, beautiful margins, and they can increase the price of their cars and people will still buy them. So this is a huge advantage to be able to increase your price and still people will buy from you. Could you say the same about Target or Walmart? I don't think so. And this kind of brand, luxury, high premium service, this good branding of Ferrari allows them to have this moat, this competitive advantage. So Ferrari is a better business than its peers, its competitors. So that's a good question to ask. How is my business different from competition? Does it have an advantage? Now, the next question to ask is it run by a good management? Is the management honest and competent? So maybe you have to dig deeper in your research, but the goal here is to check who the CEO is, the CFO is, the chairman, and look at what they've said for the past 10 years, 20 years, or go as back as you want if you prefer. But the goal is to see if they have lied to shareholders. Because if you invest in these companies, you will be a shareholder. You want to see if in the past management has lied to you, the shareholder. Because, for example, in 2015, management may have said something, made a promise to shareholders, and this promise never happened. So management can blatantly lie to shareholders. They can say that they have a plan for the next 10 years, this and this and this will happen. 10 years after this, nothing happened. So it's a lie. They were not conservative. They will say that it's not their fault, but it's the fault of this, this, and this. And if the management, if the CEO has charisma, he may hide some elements of his management teams, etc. What you want to invest in are companies run by honest management, conservative management. They put guidance. Okay, we will reach this objective in 5 years, 10 years. And what you want is that the management reaches these objectives. That's very simple, but most of the time people don't do this background check of management if the past targets have been met. And that's how you can make a stupid mistake of just blindly invest in a company without checking the background, so you can get misled with charismatic CEO, for example, charismatic CFO, etc. So by doing this exercise, you can check if the management is honest and competent to see if they have met their objectives. And the final question to ask before you buy a stock is simply the valuation. Is this business attractively priced? Does it have a good price? Is it cheap or is it expensive? So you have many valuation methods. You can use relative valuation metrics like the PE ratio, price earnings ratio. You can use the price to free cash flow when you compare the size of the business to the cash flow it generates every year. So the lower, the better. You can look at the EV, enterprise value of a business that takes into account the debt, and you compare it to earnings or free cash flow. You can use the price to book, the price to sales. You have plenty of valuation methods to see if a business is cheap or not. So that's relative ratios. The most commonly used is the PE ratio, price earning ratio. You take the price of a stock, say it's $100, and you divide it by the earnings per share. If it's $10, you have $100 divided by $10, you have a PE ratio of 10. To get a rough idea, on average, over the past 150 years, the average PE ratio for the major US index, for the S&P 500, on average, it's been 15, 16. So you can say, okay, if it's lower than 15, you can say it's reasonably cheap on average. And if you have a PE ratio higher than 15, you can say, okay, compared to the average multiple, this can be expensive. So you can get a rough estimation of if this business is cheap or not. That's not always the case. You can find everything in the stock market, but if you find yourself with a company that years after years, they have a PE ratio of 60, of 70, this business has a high probability of being overvalued. And if this is overvalued, this is completely fine because you have done the work before, you have done the research before. So you have understood the business, you know that it is a good business with good ratios, you've seen that they have a moat, a competitive advantage, and you can trust the management that is competent. That's fine. The problem is just the price. At this moment, you can instead of buying the stock, you can add it to your watch list that you will monitor over time. So you've done the work. You just have to wait a few months, a few years before the price drops for any reason, and you will have done the analysis. So when the price drops to a good valuation, you will be able to buy these stock. So I have the relative valuation metrics, PE ratio, price to free cash flow, but also you can look at some DCF, discounted cash flow model. The goal of this valuation method is to estimate the future cash flow that the business will generate. So you have done the analysis, you have done the forecast for the next 5 years for the business. So you are able to estimate, okay, I think the business will grow cash flow, free cash flow or earnings by 10% for the next 5 years. And then you use a discount rate, and at the end of this valuation method, you find an intrinsic value. So if the stock is trading at $100 and you find an intrinsic value of $160, you can say, okay, compared to my forecast, to my intrinsic value, the stock is cheap. I will buy it. So that's how you buy a stock. So for this last question, which is really important, by the way, if the stock is too expensive, the stock is just too high, add it to your watch list because you've done the work before. And if the stock is fairly priced or cheap, this is the moment where you buy. And these 5 questions that I always ask myself allowed me to have a clear plan, a clear process to buy or not a stock and to build a strong portfolio. And this method of having good questions allowed me to compound my portfolio at 24% per year for the past 7 years. So by doing this, you are very selective about picking stocks, and that's how you can pick the best investment opportunities. By the way, if you want to know the complete method I've used to compound my portfolio at 24% per year, you can check in the description below. There is a link and there will be a free masterclass. You just have to click on the link and you will receive the masterclass. Well, that's it for the 5 questions. I hope that was helpful. I have another video here, but don't just click on it yet. Make sure to leave a like and subscribe to my channel for more videos like this. Okay, see you over there.